The $3 trillion AI power crisis, where the real money is flowing. The riddle: $725 billion. That's how much Amazon, Microsoft, Google, and Meta are spending on AI infrastructure in 2026 alone. Not over a decade, this calendar year. And Wall Street is obsessing over one question: which AI company wins the most? OpenAI, Anthropic, Nvidia. But here's the riddle nobody is asking. What does every single dollar of that $725 billion touch before it reaches a chip? Before one query gets answered? Before one model gets trained? What does it hit first? It's not a GPU. It's not a server. It's not even a data center. It's a wire. And behind that wire is a power plant. And behind that power plant is an investment thesis that most retail investors have completely missed. The biggest winners of the AI revolution may not be the companies building intelligence. They may be the companies building the electricity to power it. Let's follow the money. Most people think AI is software, infinite, weightless, almost free to scale. That mental model is dangerously wrong. Every time you send a message to an AI chatbot, thousands of NVIDIA GPUs fire up, each drawing between 300 and 700 watts of power. Those chips generate extreme heat. Cooling systems kick in, drawing even more electricity. Transformers step the voltage down from the grid. The whole system hums, non-stop, 24 hours a day. Now scale that up. A single training run for a large AI model now consumes 50 gigawatt-hours of energy. According to a report submitted to the US Congress, that's enough electricity to power all of San Francisco for 3 days, from one training run. And according to Rand Corporation, the power required to train frontier models has been doubling annually. By 2028, a single AI training cluster could demand 1 full gigawatt from a single location, equivalent to an entire nuclear power station dedicated to one model. By 2030, Rand projects individual clusters could need 8 gigawatts each, 8 nuclear reactors, for one training site. This is not a software story. This is one of the largest physical infrastructure build-outs in modern history. And the grid is not ready. Here are the numbers from the most credible institutions in the world, and they are staggering. The International Energy Agency reports that data center electricity demand surged 17% in 2025 alone, more than 5 times the global electricity growth rate of 3%. Goldman Sachs projects U.S. data center power demand will leap from 31 gigawatts in 2025 to 66 gigawatts by 2027. That's more than doubling in 2 years. The IEA's forecast for 2030, global data center electricity consumption doubles. AI-specific power triples. If data centers were a country today, they would already rank 5th in the world for energy consumption, just behind Japan and Russia. And here is the most important context of all. Goldman Sachs notes that for 2 years running, consensus forecasts for this growth came in at around 20% annually. Actual growth exceeded 50% both times. The experts have been consistently, dramatically underestimating this, which means today's already dramatic projections may themselves be too conservative. Now add the fuel. The big 4 hyperscalers, Amazon, Microsoft, Google, Meta, are spending $725 billion on AI infrastructure in 2026. That's up 77% from 2025's record. Goldman projects they will collectively spend $5.3 trillion between now and 2030. And roughly 75% of every dollar, around $450 billion this year alone, goes directly into infrastructure that requires electricity to operate. The gap between what the grid can supply and what AI demands is widening every quarter. And in markets, a widening supply gap has exactly one consequence for the companies that control supply: pricing power. The 5 layers, where the money actually flows. Most investors think about AI in 2 layers. Layer 1, chips, NVIDIA, AMD, TSMC. Layer 2, the cloud giants, Microsoft Azure, Google Cloud, Amazon AWS. But there are 3 more layers below the chips. And that's exactly where some of the most powerful, least crowded capital flows are happening right now. Layer 3, inside the data center. Every GPU cluster needs power management and cooling. As AI scales toward 100,000 GPU configurations, traditional air cooling fails. The solution is liquid cooling, coolant flowing directly over the chips. The dominant company here is Vertiv Holdings, VRT. In Q1 2026, Vertiv posted 30% year-over-year revenue growth and raised full-year guidance for the second consecutive quarter. Their backlog sits at $9.5 billion. Evercore ISI calls Vertiv the single best picks and shovels play of the AI infrastructure era. Layer 4, the grid. Between the power plant and the data center sits a web of transformers, switchgear, and transmission equipment. High-voltage transformers alone now have delivery lead times of 3 to 4 years because demand has overwhelmed supply. The dominant company here is GE Vernova, GEV. In Q1 2026, GEV reported revenue of $9.3 billion, up 16%, and orders of $10 billion, up 59% organically. Their data center electrification orders in a single quarter already exceeded their full year 2025 total. Their CEO said something remarkable on the earnings call. "We're at like 10% of our directional market." GV also has a $163 billion backlog, targeting $200 billion by 2028. The stock is up approximately 165% over the past year. Layer 5, power generation. This is the most upstream layer, the actual electricity, and this is where the nuclear story comes in. Hyperscalers need power that is always on, carbon-free, and available at gigawatt scale. Solar and wind are intermittent. Natural gas is not clean. Only one source checks every box: nuclear. And so, every major technology company on Earth has launched a nuclear procurement program. Microsoft restarted 3 Mile Island. Meta signed 2 separate 20-year nuclear power agreements. Google contracted with Kairos Power for small modular reactor output. Amazon has invested equity directly into nuclear developers. The International Energy Agency reports that conditional offtake agreements between data centers and nuclear projects have grown from 25 gigawatts at the end of 2024 to 45 gigawatts today. That's 45 gigawatts of nuclear power pre-contracted for AI, before the plants are even built. The 2 nuclear plays. There are 2 publicly traded companies best positioned to capture the nuclear renaissance. Constellation Energy, CEG. Constellation is the largest nuclear operator in the United States. 21 reactors, running at a 92.3% capacity factor in Q1 2026. They have locked in over 5,650 megawatts of long-term clean energy contracts with hyperscalers. In Q1 2026, they posted adjusted EPS of 2.74, up 28% year-over-year. Management targets roughly 20% compound annual earnings growth through 2029. That guidance deliberately excludes upside from new nuclear contracts still being negotiated. They are also pursuing 1 gigawatt of nuclear uprates at existing plants over the next decade, adding capacity from infrastructure that is already built, licensed, and operating. At a forward PE of around 26x, CEG trades at a premium to traditional utilities. But CEG is not a traditional utility. It is the carbon-free baseload power provider of the AI era, and multi-decade hyperscaler contracts justify a premium. Vistra Corp, VST. Vistra tells a different story. The stock is up 695% since 2021. In January 2026, they signed a 20-year agreement to supply Meta with 2,600 megawatts of nuclear power, one of the largest corporate nuclear deals ever. Fitch upgraded Vistra to investment grade in March 2026. The key difference? Vistra trades at a forward PE of around 18x, a meaningful discount to Constellation, partly because of higher debt load, but also because the AI electricity thesis is less fully priced in. Earnings are expected to jump 49% in 2026. For investors who want the same AI power thesis at a lower entry multiple and are comfortable with higher leverage, Vistra is the value complement to Constellation's growth story. Every transformational technology in history had a hidden backbone. The internet needed fiber. The automobile needed oil. Industrialization needed railroads. And AI needs electricity. The 5 largest tech companies in history are spending $725 billion on AI infrastructure this year, growing toward a projected $5.3 trillion by 2030. Behind every dollar of that commitment is an inescapable dependency: power. GE Vernova's CEO says they are at 10% of their addressable market. Eaton's CEO says their order backlog equals 11 years of 2025 production. Constellation has locked in 5,750 megawatts of multi-decade nuclear contracts. And a thematic ETF tracking this exact thesis, the Defiance AEPO Fund, returned nearly 30% in the first 3.5 months of 2026, against roughly 2% for the NASDAQ 100. The money is already moving. The question is whether you understand where it's going before the rest of the market catches up. A decade from now, when we look back at the AI revolution, we will not remember it as a software story. We will remember it as the moment electricity became the most strategically important commodity on Earth. And the investors who followed the power, instead of chasing the software, may be the ones who built the most durable wealth from it. The AI boom has a hidden backbone. Now you've seen it.